Okay, the Lycos Value Class Fund. The Lycos Value Class Fund was the top performing fund out of over 9,000 Canadian funds for the past 3 years. What does the manager of that fund have in store for 2014? Constantine Lycos is president of Lycos Asset Management. He joins us now right here on Queen Street. Thank you for being here.
Thank you for inviting me.
Tell us your view of markets as we head into 2014.
First of all, happy New Year to you guys.
To you as well.
And our audience. My view of the markets for 2014, I'll give you the most likely outcome, but this is a number of outcomes that are possible. And of course, portfolios, when we put them together, take into account the all range of possibilities that can happen. But yeah, this is the most likely outcome here. Continuation of the 2013 trends that we saw recently, stronger U.S. economy, stronger U.S. dollar, rising bond yields in the U.S., maybe the 10-year hitting 4% during the year from the current levels of about 3%, perhaps slightly lower CAD and Aussie dollar values and these sort of things. But at some point, this will have to correct itself because you can't have a trend go on forever. Don't know when that's going to be, so, but expect that there'll be a correction and then perhaps a rotation into the global growth story, which hasn't come yet, and all things that Canadian investors favor, such as Canadian equities, Canadian dollar, the resource-based equities, and those sorts of nice things. But that's not here yet. We just have to watch for that and be positioned appropriately for that. That's a likely outcome out of many different ones. I sign about the 20-25% probability of that happening. So it's 3 in 4 chances I'm going to be wrong on this.
But you think a correction in U.S. equity markets is a distinct possibility in 2014?
Yes. Yes. Yeah.
Where are you? Tell us about the makeup of your portfolio now.
Portfolio. I have the ability to vary the equity exposure, bond exposure. We invest in pretty much anything from currencies, commodities, the gold, treasuries, high yield bonds, equities, long or short. And when markets are cheaper, you have it's a good idea to have a larger equity exposure. When it goes more expensive, you kind of reduce that exposure. So as the market has come up now, it's more natural to think that the risk has gone up. So not the best time to be deploying capital aggressively. So you're more conservative and hope for a correction. If it doesn't come, it doesn't come. But if it does, then that's great. Then we can deploy some more money, be more aggressive then. So the best time as our very smart audience knows here, is to buy when prices are low. And prices are not low now. They're not terribly high, but they're not low. So they're just about right.
So in that regard, you said you're generally positive, but you're a bit concerned, to watch for the warning signals that in fact the markets might be a bit ahead of themselves, and at some point in time getting set to potentially get more defensive. Is there a specific indicator? You mentioned the 10-year Treasury, if getting to say 4%, or is it more the market itself? If we saw the U.S. equity market advance by, I'm just throwing numbers out there. Let's say the first couple of quarters, the U.S. equity market advances by 15%. Would you say, okay, good, we got to take money off the table? So is it more fundamental data, or is it more market that you're going to watch?
It's both, because let's say the 10-year moving up a point changes the fair value of the market. So and just being fundamental based investor, that would have a big effect on that. And then the price obviously of the market, the stock prices going up, that's obviously a trigger to sell, because you say, okay, here's the fair value, here's what the price is now. Then you want to sell when prices are high, buy when prices are low. It's like, I don't make it very complicated, because it isn't.
Well, in that regard,
pretty simple.
Excuse me. In that regard, as you look forward, are you more concerned that we won't get the fundamental support that we need for the market, or is it more likely that the market might be a bit ahead of itself? It's kind of
no, I think the economic news is good, and that's possibly the problem. Yeah, when you have really good news, the market seems to appreciate that the change in something, an improvement in something, and it's a surprise in the improvement of something, to be more precise. If that makes any sense to you, I'm sure the audience here understands what I'm talking about. So if the news is good, it's not all that easy to get better. You see, that's the problem. Okay? So when the news is not so good, it's actually better, because then there's more room for improvement and a surprise in the improvement, which is what the market really likes.
Let's talk about some of the picks that you have for 2014. You like a company called TRW Automotive. It trades on New York. Tell us about that stock.
My stock picks, I have two here and a hedge in case I'm wrong with everything, as I often am. Stock picks are the implementation of my investment philosophy, which is to buy good businesses at good prices, because that seems to make sense to me, and a whole bunch of other things that people talk on your shows and others don't make a lot of sense to me, such as all the technical jargon and so on. Buying good businesses at good prices. TRW Automotive, why is it a good business? Auto parts maker. Sells to OEMs, and they're in the safety aspect of the car business, as well as other parts of the business. But the main reason why I think it will do well in the next 5 years or so is during the recession, people in the U.S. did not replace the cars as often as they did before. So the average age of a U.S. vehicle is about 11 years old, and that's kind of old. Historically, it's been about 6.5 years. So the replacement rate now is going to be higher. Production rate for cars is going to be higher, above average for the next few years, just to get to a more kind of normal average age for vehicles out there. And auto parts makers are going to participate in that. Now, of course, that doesn't make a stock like TRW a good stock just because the fundamental story is good. You also have to have a good price, and the price on this is good. My fair value analysis, which I do with everything I invest in, indicates that the stock may be as much as 45% undervalued. So if they deliver and potentially a surprise to the upside, then the market will reward that, and you'll get a very nice gain for the year, maybe even a 50% gain for the year. That's
very quickly. I think you mentioned that you have a hedge as well that you're recommending. Is that the iPath S&P 500 VIX Short Term ETF?
That's correct. The VIX index is the fear indicator for the market, and right now it's under 14, I believe, and historically the level varies between, on average, 18 and 20, and as an average, and the actual limits are between 10% on the low side and 90% during the crisis, and you want to buy it when it's low, because it's just a matter of time before it goes back to its average or above average level. So you buy insurance. In this case, this is insurance when the price is cheap, and hope that you don't need it, and hope everything turns out. But if market takes a 20% dive, you can probably double your money on that. So
thank you very much for joining us.
Thank you.
That was Constantine Lycos. He's president of Lycos Asset Management. He joined us, of course, right here on Queen Street.